Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Thursday everybody. We start as we usually do with the salient economic updates from the last day or so, but there's been so much from the last 24 hours that today's episode will focus almost entirely on important economic updates. Yesterday, Wednesday, Chinese gaming stocks regained some ground after the last few days of walkback from Beijing. We remember gaming and technology stocks suffered an $80 billion rout last Friday after the country's policymakers signaled more tough rules for the industry are likely coming. Shares in Tencent, China's biggest gaming company, had tumbled more than 12% on Friday, but saw 5% clawed back in trading in Hong Kong on Wednesday. Rival and China's number 2 gaming company, NetEase, rose about 10% in trading yesterday after closing the previous session down almost a quarter. The Friday shock acted as a reminder to investors of the risks from unpredictable policies in China and that the technology crackdown isn't over. These investors obviously don't watch China Update. Quote, "For the last couple of years, there has been no end to a range of China watchers getting up on TV channels and saying things like, Beijing is being pragmatic, the tech crackdown is over. Over the last 2 years, they have been proven wrong over and over again." End quote. Next up, we need to discuss property once again. A meta-analysis published this week shows that the consensus from 10 investment banks and securities brokerages, including Goldman Sachs Group Inc., Morgan Stanley, and UBS Group AG, is that the slump in China's housing construction will continue well into 2024, dragging down economic growth and further straining local fiscal pressures. This would put China on track to post a record 3 straight years of contractions in property construction. Most regular China Update viewers would likely agree with this outlook. According to Bloomberg Economics, real estate-related demand accounts for about 20% of GDP now, down from 24% in 2018. The country's main measure of real estate investment fell 8% on year in the first 11 months of 2023. It was 8.4% down in 2022. Goldman economists expect a double-digit contraction in real estate fixed asset investment next year. Other banks are less bearish, but expect contraction. UBS, for example, sees a 5% decline. Both Goldman and UBS see real estate sales dropping 5% next year. We remember from last week it was estimated that a 5% decline in prices can lead to an aggregate loss of 19 trillion yuan in housing wealth, potentially reducing household consumption by at least 430 billion yuan. We note that Logan Wright, director of China Market Research at Rhodium Group, is a contrarian voice. He believes China will see only a very modest contraction in both real estate construction and sales in 2024, pointing to improving government land sales and expressing, quote, "The worst of the industry's correction is already behind us." End quote. Whether it's a modest or deep contraction, if Beijing wishes to push for 5% growth again next year, then we should expect more stimulus. Quote, "I expect housing stimulus to continue to be scaled up. My baseline scenario is that the housing crisis continues in the first half, but gradually improves in the second." End quote. Housing, of course, will be one of the big areas to follow in 2024, and so we'll have to see how things unfold. Next up, we continue with the economy. I hope you're enjoying today's episode. If you're getting some value from this episode, I only have one ask. That is to like and subscribe. This is the primary way in which this channel grows. The main way it is shown to new people is if the algorithm is happy. For anyone who wants to help keep the channel financially sustainable, which allows me to continue doing this every day, open and free for all, Patreon and Buy Me a Coffee links are in the description below. My commitment has been a channel open to all that is reliant primarily on subscriber support rather than corporate sponsorship. And with your assistance, I know I can keep it that way. Thank you so much, everybody, for the ongoing support. Okay, let's continue with the economy. According to a statement from the state-run China State Railway Group published yesterday, China is expected to put more than 2,500 kilometers of high-speed rail lines into operation this year, the highest figure in the past 4 years. I just realized for our American listeners, I should see how long that is in miles. 1,553 miles. This is all yet more evidence that China's growth this year has been fueled with local fiscal spending on infrastructure. 5 new high-speed rail lines, as well as a super high-speed railway hub in Guangzhou, also known as Canton in English, started operation this week. Chinese financial media outlet Yicai, reporting on the development, writes that the 6 years between 2014 and 2019 were a peak period for the completion and commissioning of high-speed rail lines, with over 4,000 kilometers coming into operation each year, except for 2016 and 2017 when only 2,000 kilometers were opened. In 2019, a record high of 5,474 kilometers of high-speed railways were put into operation. 8 Chinese provincial-level regions had more than 2,000 kilometers of high-speed rail lines in operation by the end of last year. Eastern Anhui, a relatively poor province, ranked first with 2,522 kilometers, approximately 1,600 miles. What is also noteworthy is the opening this week of the first high-speed railway connecting a Chinese city on the China-Vietnam border with the nation's national network, underlying Beijing's efforts to deepen trade and investment cooperation with its Southeast Asian neighbors. The dual-purpose line, which can handle both passengers and freight, has a maximum speed of 200 kilometers an hour, 124 miles per hour. A joint statement released during the recent Xi visit to Vietnam, which we covered at the time, mentioned a 392-kilometer, 244-mile line that, once constructed, could effectively connect the two countries' railway networks. But despite having appeared in every diplomatic declaration between Beijing and Hanoi in the past 8 years, the Hong Kong-based South China Morning Post writes, quote, "The Laotai-Hanoi-Haiphong Railway project has remained on the drawing board due to Vietnam's concerns over costs, anti-China sentiment, and broader geopolitical factors." End quote. Next up, according to official data published by the National Bureau of Statistics on yesterday, China's industrial profits jumped in November, largely through the help of base effects from the last 2 years. The official data show that profits jumped 29.5% year-on-year, greatly outpacing the 2.7% increase in October. Profits for the January to November period were still down 4.4% from a year ago, however, underscoring the base effects from November. Last month, China's consumer prices posted the steepest drop in 3 years, while declines in factory gate costs also deepened. Xing Zhaopeng, a senior strategist with ANZ Bank, explains on the numbers, quote, "The big picture is that destocking cycle has yet reached the end. We need a bottom of inventories to confirm a turnaround of the growth outlook." End quote. And finally, for today's episode, US-based Bloomberg reports that China's BYD Co-Limited is poised to surpass Tesla Inc. as the new worldwide leader in fully electric vehicle EV sales. Quote, "When it does, probably in the current quarter, it will be both a symbolic turning point for the EV market and further confirmation of China's growing clout in the global automotive industry." End quote. Indeed, as we have seen, China now rivals Japan for the global lead in passenger car exports. Quote, "The competitive landscape of the auto industry has changed. It's no longer about the size and legacy of auto companies. It's about the speed at which they can innovate and iterate. BYD began preparing long ago to be able to do this faster than anyone thought possible, and now the rest of the industry has to race to catch up." End quote. Recently, Elon Musk tweeted that BYD's vehicles are, quote, "highly competitive these days," end quote. BYD was initially in the batteries business, the first Chinese lithium-ion supplier to Motorola and Nokia in the early 2000s, before jumping on the EV bandwagon as it started getting going. Due to this, BYD is one of the few automakers that also makes its own batteries. Warren Buffett's Berkshire Hathaway invested about $230 million for an almost 10% stake in the Chinese automaker back in 2008. As of 2022, the value of the stake had increased about 35 times to near $8 billion. Buffett's late partner, Charlie Munger, has heaped praise on BYD's founder, expressing in a podcast earlier this year, before his passing obviously, quote, "The guy at BYD is better at actually making things than Elon is." End quote. But international politics could complicate this picture for BYD. The EU has been an important market for Chinese EV sales, and as regular viewers know, Europe looks poised to join the US in slapping higher tariffs on Chinese car imports. However, there are other markets which automakers around the world, including Chinese EV makers, are eyeing up, especially Southeast Asia, the world's fastest growing EV market. Quote, while the level of government subsidy has played a role in China's tremendous EV growth, after tearing down a BYD Seal sedan and finding a 25% cost advantage over legacy competitors, Paul Gong, UBS Group AG's head of China Auto's research team, concluded that Chinese manufacturers are likely to own a third of the global car market by the end of the decade. End quote. It seems that the race is on. Okay, that is today's episode of China Update. Let me know in the comments whether you would buy an EV or a Chinese-made EV. Thank you so much everybody for watching today's episode. Have a wonderful Thursday, and I will see you all tomorrow.